Welcome back to this broadcast. The indices have lost about 7% and just about 350 points away from a lower circuit for the Nifty 50. Everything else is out of shape in today's session, taking cues from the global markets. Getting in prominent market voices across the day, and right now we've got one such voice joining in right now. Market veteran Shankar Sharma is with us. Shankar, thanks very much for taking out the time. Devina here along with me is Neeraj. What are you making out of this pandemic-driven fear that's driving the markets in a frenzy right now?
Well, it's not a good situation, but I think markets are waking up gradually to the fact that this was not equivalent of the SARS or some other cases that have come periodically. This appears to be of a completely different dimension. And anybody who's observed these viruses over the years knows that this time it does appear to be different. And remember, this is coming at a time when markets were already on the high. So SARS came when markets had already undergone the dot-com down. This is coming at markets globally at a high. That is, the Nifty came at a high. So therefore, there's a lot of left to fall in because the markets are just falling because the earnings forecast is just out of the window. The GDP forecast of the world.
Shankar, I'm sorry to just come in. May I request that maybe we can call you back on a landline because your voice is breaking right now and somehow we are not able to get your answers. We really love you to have you on this conversation. So we'll just maybe dial back on another number. Viewers, stay on because you don't want to miss this conversation. From all the other things that he said on Twitter as well, I must mention that he's saying that a bull market may happen because of many reasons, including Ford, central bank manipulation, etc., etc. But a bear market is always based on only one reason, fundamentals. So we would really want to know from him, how does he view the current set of fundamentals and therefore what could be the template for the markets in the near term. So we'll be back with Shankar Sharma in just moments from now. But while we are just waiting for that, the point that I think we were trying to make even in the conversation gone by, which is what is happening right now to the markets, which is fear gripping the markets. The indicator, this is the fear and greed indicator, which has surpassed the lows last seen during the global financial crisis. We were at those levels back then here in 2008, and now we've seen that kind of fear coming into the markets in the current point of time. Okay, Shankar is back with us. Shankar, sorry, you were making this point about how this time is different simply because of levels and a lot of other factors being different compared to the previous times.
Yes, correct. So, I mean, if you go back to 2008, and even the SARS crisis, 2008 happened because of financial leverage. Financial leverage can be resolved through additional capital, which the world provided, central banks provided. SARS came at a time when global markets had already undergone a brutal bear market for 3 years after the dot-com meltdown. So it happened in 2003, the bear market started in 2000. We'd already undergone a very substantial bear market. The Sensex had already crashed, I think, 50% by the time the SARS virus hit the world. So there was not much room left to fall. Here, this is happening at a time when everything was at a high. Despite global earnings picture, Indian earnings picture not being that robust on a widespread basis, it was being contributed by a very narrow set of companies. We know in India, just a handful of companies were driving earnings growth as well as the stock market growth. When a narrow market collapses, reasons can be many, but it will collapse for a genuine reason, and that is that the earnings outlook has just vanished, at least for large parts of the market. So these are the fundamentals really looking terrible, I mean, to say the least. That's all I can say.
Fall was warranted. We take on board that hypothesis. What happens now? What do you think happens now?
I think, if you look at globally, I think the S&P made a 52-week low yesterday for the first time. I think the NASDAQ may have made it or might be close to that. So it has just made a one-year low. Remember, bear markets typically can go on for a pretty long time. And again, I point out a context. 2019 for the world, barring India, was an absolutely blowout year. We had like a 37% rise in NASDAQ, 50% in Russia, 30% across Europe. With that kind of a market, in any case, the following year is almost never a good year. Look at history of markets. Very few years you will see back-to-back gains of 30+%. Okay, it happened only in 2006 and 2007 in living memory. And you know how 2008 happened. So again, it's important to look at data. And when 2019 ended, I was telling my team that we'll be lucky if we end flat for the 2020 year, because everything is toppy. All asset classes did well, and you just need a small fire, let's just spark to ignite, a big sell-off. And we found that small spark coming from the coronavirus. But it just happened at a time when markets had a very strong 2019, and hence the fall is being. The magnitude is such that you can go down a long way before things stabilize, because you've run up a long way in the last few years.
That's really true, and we will really be lucky if we end 2020 on a flattish note after the kind of sell-off that we've seen. But Shankar, just wanting your view then, while the rest of the globe and while everybody is anticipating liquidity to do the trick, and a lot of expectations from the Fed and coordinated effort from central banks to put a fix to this, this will not inherently deal with the demand and the supply shocks that are there in the system. You've got Japan announcing a stimulus of $4 billion. You've got the Australian government talking about a stimulus package. Donald Trump is talking about payroll tax cuts. How is all of that going to improve, what you're going to see in terms of a pickup in earnings or pickup in overall growth?
See, again, we tweeted on our First Global handle yesterday that bear markets end. They absolutely end. But it's not as if they end, and I'm talking a bear market means something like what we are witnessing right now, not like a garden variety 10-15% correction, which will happen routinely in markets, and we have seen many of that. Even in 2018 December, we saw a pretty severe fall, but that was more like just a correction of a pretty strong bull market. Here you're talking a significant fundamental driven bear market, which is exactly what 2008 was, which was exactly what 2000 was, which was even what 97, 98 was the Asian crisis, right? None of those crises got over in 2 months. None of them. So, the Asian crisis took 2 years to wind down. The SARS and the dot-com crisis took 3 years to wind down. The 2008 crisis was at least a year and 5 months or 6 months. Here we are the first month or maybe the second month into this major collapse. Governments will come across the world with packages, but it takes time to seep in. These things don't turn on a dime. The scale of economic disruption, I have never seen anything like this in my 30 plus years of analyzing markets. I'm talking on a worldwide basis, let alone India. So no matter what governments do, things will take time to come back to normal, and you're talking several months. And even getting a vaccine for this is probably 2 years away. This is what I was reading. It's not like you can just get a cure done immediately. So I think it's a very significant problem, and to expect markets to just shrug them off is being very, very foolhardy.
What would the advice be to an investor who's watching you right now, Shankar, and who is fearful that this disruption could continue for longer? They've already seen their portfolios bleeding out, probably 5% additional cash that they would have in their kitty after deploying 95% already. What's the advice to such an investor?
Well, my advice always has been this, and this is what I always say wherever I'm called, is that just being a one-trick pony, which is all an equity pony, is not wise. You need to be diversified across asset classes. And you will find in situations like this that if you were genuinely and tactically diversified across, 4 or 5 major asset classes, you were at least not as badly hit as a pure equity player. And people forget these lessons. All the lessons are out there. It's not that I'm saying anything new. It has been known for maybe 100 years. But we forget them in easy times. And when tough times happen, we always sit back and regret that why on earth did I not have significant gold or significant some other commodities, or some significant fixed income exposure. Why was I all just listening to television and going out and buying only equity? My view is that this year is not going to belong to equities. Selectively, yes, there will be pockets, but definitely not a widespread equity play this year for sure. There are other places to park your money in.
Okay, one question, Shankar. A lot of people who are optimists are taking refuge under ratios of the past, the earnings yield to bond yield ratio, which might be at levels from which we have typically bounced back. My question to you is only this: if you in your career have not seen anything like this before, can you go out and even attempt at predicting the extent of damage that could come in? We might recover from these levels, but my question is, how can one say with even a remote degree of certainty?
Which is what, again, my view is that there's no point in being too early in these trades. Markets give you enough clues, when things turn. And even if you bought 10%, 20% higher, with the comfort of knowing that now the worst is over, I think you're just fine. There is no point in just trying to be, the first guy, at the point a bear market becomes a bull market. For example, in March 2009, when the last bear market ended, okay, and I'll confess that while I thought it was going to end, I did not act on it because the previous 15 months has been so brutal that one was just scared to even change one's thinking. But, I changed 3 months later. I changed in the month of June. That's already when 30-40% rallies had happened in stocks. But did it matter in hindsight 10 years later? No, it didn't matter. It did not matter one bit. I was buying, therefore, with the comfort that, look, that bear market is dead and now it's a bull market. And I've seen 2-3 months of solid price gains, solid sort of momentum. Now that's confirmed. I did not buy a 2-day rally or a 5-day rally or a 1-week rally. And we will get those rallies. I'm repeating, we'll get those rallies in the current phase also. But we need something which is more durable, a month, 2 months, 3 months of solid stock price gains, some good news seeping in. That's the time when you go out and buy, even if it is 30% higher. Yeah, that doesn't matter.
One last question from my end. 2 days ago, you tweeted out that the situation for India's market is a lot worse than was in 07-08. You briefly alluded to it in your earlier answer to Devina as well, but you mentioned that this may be different for India and virus worse than the GFC for India as well. So,
without any doubt.
So would you reckon that the pain is not out of the system as yet for Indian market?
Well, I mean, since we are talking virus and health, think about it. The virus affects people who are sickly. I mean, it will affect everybody. It can. But it affects more the elderly, more the people with low immune systems, and more people who are sickly. India in 2007, going into 2008, was a robust, thriving, vibrant economy which had just grown 10%. 2007 was a 10% growth year with an under 1% fiscal deficit. I mean, you were going into a huge crisis, once in a 100-year crisis, in the pink of financial health. Corporate India was not in anywhere close to the kind of situation it is in right now. Hence, India came out of the crisis looking actually the best of any country in the world. And after that, we still grew 7.5% CAGR, which is better than practically any country coming out of the crisis. This time, you were already down to 4%, 4.5%, even if you believe these numbers, probably more like 2, 2.5%. And then you get hit by a crisis like this. You were already struggling. Rural growth is already struggling. Corporate India is leveraged. Banks don't want to lend. On top of that, the last thing we could afford is a virus situation. So you are actually a high-risk person to contract a big problem, which is genuine cut to economic growth. So India is just not equipped to handle this. I'm not talking medically. I'm just talking financially.
So, Shankar, within this entire event, the fact that crude oil prices is the other, in the mix, the other element in the mix, does that in a way prove to be a silver lining for India? And therefore, should one also take cognizance of the fact that, GDP numbers may look slightly better, inflation numbers may look slightly better, and therefore, a lot more headroom to do a lot more things to spur up the economy?
Yeah, look, I'm not of the view that a $20, $30 oil is anyway good for India. It is only good if it happens in the way that 2016 or 15 crash happened, when nothing else changed in the world and just oil fell, right? There was no global macro dislocation. It was just a huge technical fall from 95 or whatever it was to like $27, $25. That kind of thing is great for India. Right now what is happening is crude is only reflecting the global meltdown in GDP growth expectations. When this happens, India is not going to be immune to that. And remember one more thing, that crude is only one component. Crude fell from $150 to $30 in the middle of 2008. And the market still fell from 15,000 to 8,000 in the remainder of the 9 months going till March 2009. So it's not that crude, in an overall global meltdown is going to help India. It helps, but it doesn't help, economic growth, because it's just actually a reflection of the poor fundamentals of the global demand situation. And that is the problem. 2016 was a very different fall, but this is not the same.
Shankar, it was great talking to you. Thank you so much for accommodating our request. Really appreciate
No problem.
it.
Thank you.
Shankar Sharma there with his views. That's all that we have on this hit for the markets. We're still down about 7% on the Nifty.
According to a recent report, women today